The market's most crowded trade just crossed a psychological red line. The magnificent 7 inches, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, now hover around a $20 trillion combined market cap, roughly on par with China's entire nominal GDP. When a handful of US stocks add up to the world's second largest economy, that's not just a fun fact, it's a flashing warning light. Why does that matter? Because concentration is the oxygen of bubbles. When returns funnel into a tiny slice of the market, both price discovery and risk management get distorted. By mid-2025, the Magnificent Seven had swollen to roughly 1/3 of total US equity market value, a degree of top heaviness that leaves benchmarks and passive investors hostage to a narrow narrative. Endless AI growth, flawless execution, no regulatory friction, and no macro shock. If that narrative cracks, the index doesn't bend, it buckles. A historical warning: the dot-com crash and Nasdaq's collapse. To understand how far overvalued markets can fall, look back to the dot-com bubble. On March 10, 2000, the Nasdaq Composite peaked at about 5,132.52 points. By October 2002, it had fallen to around 1,139.90 points, representing a drop of roughly 77–78%. Many shorthand this as an 80% collapse. Virtually no tech stock was spared. Even companies with strong branding or real products lost most of their value. The lesson is clear. When too much hope is priced in, reality can erase years of paper wealth in months. Why the next crash could be bigger with that in mind? Here's why the Magnificent Seven reaching a combined valuation close to China's GDP could presage something even more severe. 1. Even greater concentration risk. The dot-com crash wiped approximately 80% from Nasdaq, but today's setup is even more concentrated. 7 names dominate 1/3 of the US market. If they stumble, benchmarks crash. 2. Unrealistic expectations baked in. The 2000 bubble priced in internet forever. Today, investors assume years of flawless AI growth, endless chip demand, and no regulatory setbacks. That's dangerous. 3. Index and passive fund mechanics. ETFs and index funds funnel billions into these same names every week. This magnifies both upside and downside. If outflows start, selling pressure becomes systemic. 4. Globalized risk channel supply chains, China trade disputes, energy shocks, global factors that didn't matter as much in 2000 now directly impact the giants. 5. Valuation extremes. Price-to-earnings multiples and market caps are already stretched. Any slowdown in earnings or shift in interest rates can slice valuations brutally. Conclusion: in 2000, the Nasdaq lost nearly 80% of its value. The Magnificent Seven today are more concentrated, more globally entangled, and more reliant on a single narrative, AI. That means when the air finally escapes this bubble, the crash could be even bigger, not only in market cap lost, but in systemic impact across pensions, savings, and global liquidity. This is not just another cycle. It's risk at planetary scale. If you found this analysis helpful, don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss updates on markets, bubbles, and financial risks. Your support helps us bring you clear, no-nonsense breakdowns of the forces shaping our future.